Hello and welcome to the Investor's Guide to Asia, where we go in search of the best insights and investment stories from across the region. I'm Stuart Rumble, Head of Investment Directing for Asia Pacific at Fidelity International. On today's episode, it was 3.5 months since the conflict in the Middle East closed the Strait of Hormuz, triggering the worst global energy crisis in decades. Back then, all expectations were that within weeks we would see a profound shock to Asian economies, and yet that hasn't quite happened, or at least not to the extent that we feared. Why has Asia been so resilient, and can that be sustained in the face of continuing high energy prices? In search for answers to these questions, I'm delighted to be joined in the studio by two portfolio managers in the thick of the action. From the fixed income team, Terrence and multi-asset portfolio manager, George Efstathopoulos. Hi, guys.
Hello.
Hello, Stuart.
George, can we start with you and maybe just putting this into broader context? We've obviously seen quite a lot of divergence across the Asian economies. Some have remained quite resilient, while others have obviously kind of suffered higher inflation, some controls around energy, for instance. You've described this as a scenario of the haves and the have-nots. Can you explain what that means, please?
Yeah, it's a story of two tales, North versus South. Before March, before the Middle East developments, we also had a story of haves and have-nots. We had the big AI megatrend story that we're having, and Asia has been at the heart of that. All the capex from the US has been moving into Asia, but not all of Asia. It's predominantly been North Asia, the likes of Korea, the likes of Taiwan. So with the haves and have-nots was already a story before the Strait of Hormuz sort of developments. And since then, that story continues because on the one hand, you have China, as March sort of happened and the conflict sort of started, everyone was concerned that China is going to be at the epicenter of this crisis because China gets more than 90% of oil exported from Iran. However, China has been quite resilient. Look at the bond market, look at the currency market, it's been quite resilient. Why has this been the case? Because China has been very strategically managed to diversify its energy inputs in the past 10 years. A lot of the other places have not been able to do that. If you look at Southeast Asia, again, they have not been part of the AI capex cycle, benefiting from that. And also when it comes to energy, they are not energy resilient, they're not energy independent. And then you can see the impact that has had on its bond markets, its equity markets, and its effects as well.
There's been a lot of focus, of course, that China has drawn down on its inventories and there's been some price controls as well. But it sounds like you think that this is more durable resilience. Should we be looking at China and maybe Asia in a slightly different way to in the past?
I think we do. If anything, I think the interesting story with China is that, again, because China has managed to strategically diversify the past 10 years, there's going to be a lot of other governments around the world, governments where their countries, again, are energy importers and they don't have that independence. They will be looking at China and they're going to be thinking, we need to do what China has done. So when it comes to China, not only, we've seen exports in China grow month after month, quarter after quarter, year after year. China's exports channel has been very, very strong, moving up the value chain, now exporting EVs, which are taking over the world. China might find an additional export channel growth, and that might be China exporting IP and know-how in green transition at a time when governments around the world will be trying to replicate what China has successfully done.
So there's some resilience through export growth. On the flip side, you mentioned the have-nots, their North versus South divide. Terrence, I guess looking at Southeast Asia, they're expected to be where we would see some vulnerability. They're importers of energy. What worries you most when you look at that region?
If you think about categorically, what has worried me the most, of course, over the short term is the inflation impulse. If you think about the ASEAN or certain South Asian countries in general, a couple of more common issue, perhaps it's first of all capital flows. So previously, some darlings within the southern side of Asia, say for example India, have had the capital flow situation turn. So now they are perhaps under a bit more pressure on the capital flows and therefore the current account, which of course has been exacerbated by the balance of payment shock that we have seen because of the oil price hikes. And the second part, of course, it's as equally important, of course, has been the underlying growth dynamic. So to George's point, they are the have-not. So except for perhaps a couple of countries like Vietnam, they're in generally less exposed to the tailwinds of AI in terms of capex and the underlying export dynamics. And therefore, generally speaking, they are under a bit more pressure in terms of growth, perhaps versus North Asia. And that means they are, from a policy mix point of view, growth is a bit weaker. Inflation is actually coming up quite heftily. And therefore, from a fiscal and monetary side of things, it makes it quite difficult for government to put forward a coherent package, not just to perhaps put out the fires in the short term, but also address the more secular problems that you have from a capital flows point of view.
We talked about AI a little bit there, which is, of course, the other big narrative that's driving markets. Maybe before we explore that, you touched on policy, Terrence. Now, there's a bit of a dilemma, a bit of a challenge here, isn't there, for the central banks of Asia in terms of obviously dealing with higher inflation, but at the same time, trying to not stymie growth.
First of all, at the beginning of the conflict, across most of the Asian Pacific economies, including both North and South Asia, we have seen perhaps a bit more heavy-handed measures from a fiscal point of view. So we have seen quite a bit of fiscal subsidies that are targeted to reduce the impact at the pump, and especially to the consumers. After a while, however, we have seen that actually subside quite a bit. Part of that was because for a couple of economies, their fiscal headroom is actually not that strong. And for the others, they have basically shifted into other policy priorities. And therefore, in the past couple of weeks, we have seen the likes of Philippines, India, Indonesia, and even Korea come out and have various measures to try to protect their ethics and ultimately make sure that when and if the conflict actually resolves in a relatively short period of time, that would not feed into ultimate inflation expectations and make them even trickier policy backdrop on a forward-looking basis.
I think what's been really interesting is looking at the policy response out of Korea as well, particularly given the weakness of the Korean won, even despite the fact they've been obviously at the epicenter of this AI boom and build out. George, you've had some thoughts in terms of how that's impacting your market view.
It goes back to the haves and have-nots story of two tales, and the central banks right now that are hiking or potentially will be hiking, but for different reasons. You've got the good hiking and the bad hiking. When it comes to South Asia, they're hiking for the wrong reasons. They're facing inflation, they're facing stagflation, and they need to hike to a large extent to defend their currencies, to defend their bond markets, compared to perhaps the likes of Korea, for instance, where actually the economy is very, very strong. And if anything, they're worried about, the domestic inflation being strong. You look at Seoul property markets, that's being reignited. There they are hiking for the right reasons. The interesting thing is, however, that whether you look at the currencies in the south or whether you look at the Korean won, both have been under pressure, but for very different reasons. If we look at the Korean won, it's been under pressure not because of its concerns about the market. If anything, the fundamentals in Korea have been on a particularly improving trajectory. You look at the terms of trades, again, benefiting from being at the very heart of the AI capex cycle. The reason why the Korean won has been under stress is because two reasons. Domestic investors are looking at what's happening in the US equity market, especially now that IPOs are on the rise. They want to participate. That's leading to capital outflows. And the other bit is foreign investors who have been embracing the Korean equity rally. It's been so strong, that rally, that they, if we look at concentration of these stocks, it's hitting certain thresholds. They have to sell, they have to take profits because of concentration limits. It's a vastly different story versus the South.
It's been really interesting actually watch that play out in mutual fund flows as well. Investors being constrained by concentration limits in their own portfolios. I'm sure this is a very real challenge for the audience. One country we haven't touched on yet, which I think you would put into the have category, is Japan. And they're also on the cusp of potentially of raising rates to 1%. And you've liked Japan equities. So is this a good hike, George, or is this going to derail the outlook for Japan equities?
I think the easy way to answer that question is Japan has had 30 years of deflation, disinflation. Japan is coming out of that deflation, disinflation in a very convincing manner. Just look at the latest wage growth data that came out a few days ago. The nominal wage on the way up, real wage positive and growing. And again, Japan is convincingly coming out of deflation. The Bank of Japan needs to hike. They need to be hiking more. If anything, we think that the Bank of Japan is behind the curve. What has that meant for us in terms of equity markets? We've liked Japanese banks because, again, the Bank of Japan is hiking. The curve is relatively steep. The economy is doing quite well. And, we are seeing the hikes sort of come through to some extent. Another place that we also like is Japan mid-caps. And for us, this is part of what we have framed as, in a world of globalization is facing headwinds, we like to focus on places and domestic revenue generation, especially in economies and markets with something big, something different is happening. And this is where Japan nicely fits the bill because Japan is coming out of decades of deflation. And with this very strong wage growth, it means that the domestic economy is thriving. And as a result, domestic revenue generation is thriving.
You referred there to the shape of the government bond yield curve and steepening, which means that longer rates are higher than shorter rates at the moment. That's good for your bank's trade. Terrence, what does that mean for your portfolio positioning? Are you kind of negative on the long end of the JGB curve?
I think we have to unpack that a little bit. So first of all, what determines the steepness of the curve? Of course, you have the liquidity side of things and the rate expectations in terms of hike and reduction of rates, which would, of course, be more sensitive towards the shorter end of the curve. Whereas in the long end, of course, you have longer term inflation and growth expectations, but increasingly for many of the economies globally in core rate or in Asia Pacific market, it really is about the fiscal picture and importantly, the credibility of the central bank and the government. And I think this is where Japan is a very interesting example. After Takaichi's landslide victory, there has been a repricing in terms of the overall rate hike expectations. And increasingly, we have seen a steepening bias of the curve. If you look at 2s10s, 510s, 530s, it has been, for all intents and purposes, a one-direction trade. The market is effectively telling us that we do believe there will be continued growth of the underlying Japanese economy, but they're not so sure anymore, to George's point, whether BOJ might potentially be behind the curve. And because of that, that has increased the term premium. And therefore, if you look at right now versus, for example, core markets, Japan is actually one of the steeper curve. And therefore, if we think about it, we do believe over the shorter term, there is a very high probability of BOJ hiking. But the important part is, how does it signal the future hike trajectory? And at this point of time, we have already seen local participants, for example, the life insurance companies that have come out and said that they like the current yield levels and importantly, the coupon levels of many of the longer dated government bonds. And therefore, perhaps versus a couple of years ago where the bulk of the marginal buying is actually on the global investors, where they want to do it outright or they want to do it FX hedged, we are increasingly seeing the emergence of domestic buyers, which we believe it will be a very important source of buying to stabilize the very long end of the curve.
It sounds like Japanese government bonds are becoming interesting for the first time in a long time, including to sort of global investors, in the same way that they've become very interested in Japanese equities for the domestic drivers of that market. But it also speaks to, again, the dispersion, this idea of haves and have-nots, North Asia versus South Asia. And that's played out to a certain extent, as we've seen in financial markets. Has there been anything over the last few months that have kind of surprised you in terms of this level of dispersion compared to what we might have seen in the past?
I think what has been the most surprising aspect is actually the very strength of the hard currency credit spreads. And if you focus on Asia hard currency credit spreads specifically,
Credit spreads is this extra premium for taking the risk of investing in a company or a credit risk versus what's perceived to be a safe haven government bond.
precisely. So if you look at the Asia Pac hard currency, so let's say, for example, US dollar credit spreads, many of the bonds are trading even tighter than the pre-war level. So of course, we've all talked about the divergence within the economies, but on a broad setting, if you think about at the start of the conflict, one would not necessarily expect many of these issuers, be it sovereigns or companies, to be trading actually tighter, stronger. That, of course, in itself demonstrates a few things. first of all, we have very much a structural bid within the local investor. So a few years back, if you see, say, for example, such a big macroeconomic event, you would see basically a pullback of many of the foreign money into their home market quite naturally, right? But because right now the market has been dominated by domestic buyers, we have seen, if nothing else, they've actually come in, take advantage of that weakness to buy on dip. And therefore, we have seen much stronger resilience and, empirically speaking, much lower beta for much of that market.
Are the domestic investors picking up on something that maybe global investors aren't? Or is there just a level of complacency perhaps creeping in?
Private debt is a big thing in the US, somewhat in Europe. There's almost no private sort of credit in Asia. And if you see why this has happened, the collapse of a lot of sort of the pricing there is because there's, software companies. There's been a lot of concerns around software companies. But again, if you look at Asia, to a large extent, there's a lack of that play in Asia. So in some ways, when it comes to investing in credit, boring is good. You do not want to be in the headlines. We can recall 5 years ago, China property was in the headlines. That was not good news. Right now, China, Asia credit is not in the headlines. US credit is on the headlines, mostly on the private debt side, but of course that can have ramifications beyond that. So I think that's a very interesting development, which perhaps is it complacency, is it not? But let's also remind ourselves that Asia does not have that dynamic that the US has, and it's a headwind for the US.
We start with, again, at the beginning of the conflict, most investors and most clients would think that, oh, Asia is an outright short or just stay away from it. But after we have seen, first of all, in general, a much higher level of resilience than people would expect, even for the more vulnerable economies. And secondly, we have seen enough divergence. So one of the things that we are trying to hammer home to clients in the fixed income side of things is, when you see divergence, it's arguably very often the biggest return driver for you on a more sustained manner. So in terms of saying, oh, we are not going to invest in Asia, Asian fixed income for that matter, because of that conflict, what we are telling them is embrace what we have right now, because there are opportunities in rates, in FX, in credit that will allow you to basically extract more value, perhaps not as a correlated manner as your other bets as well, importantly.
Yeah, it's interesting. When I talk to investors, actually, you're right. When there's uncertainty, that creates difference of opinion, which creates opportunity as well as risk. And sometimes that is a slightly easier environment to invest in while everybody's piling into the same trade and there's a lack of dispersion. Of course, one of the factors we've already touched on this, resilience coming through in parts of North Asia due to the AI boom. And that's the other sort of really big narrative in markets at the moment. We've obviously seen a lot of the value accruing into the semiconductor names, particularly in Taiwan and Korea. George, how sustainable is that?
We do think that this has legs. It's important to remember this is a once-in-a-lifetime capex cycle. And I think the important data point we need to be monitoring here is US consumption, the resilience and strength of the US consumer. Because without that, everything falls. Because without that, obviously, the US companies, the hyperscalers, sort of won't be able to spend the way that they're spending. And then this will have, obviously, the ramifications in the entire supply chain, including, of course, the semi companies in Taiwan and Korea. So at the beginning of the year, Q1 of 2026, there were a lot of concerns around jobs markets in the US. And if anything, the markets were pricing in cuts from the Fed. That has now, to a large extent, reversed. If anything, now we're starting to see hikes being priced in. Why? Because the jobs market has been coming in quite strong. From our perspective, this means that we're getting a bit more comfortable about the US consumption. And if we think of the ripple effect, essentially, US consumer strong, which means the hyperscalers keep spending, keep generating cash. In the past, that cash would be transforming into buybacks. For the past 10 years, US has been the biggest buyback market in the world and has obviously benefited its equity market as well. The buyback yield is coming down in the US. Instead, where is that cash going? The cash is still being generated. Where is the cash going? The cash is being spent as capex, and all that capex is going to Korea, is going to Taiwan. Again, this goes back to the North Asia sits at the heart of the AI capex cycle. And interestingly, buyback yield is coming down in the US. Buyback yield is going up in North Asia. corporate reforms, dividend payment, dividend yield, buybacks. Essentially, we're seeing an interesting, almost like a reversal of what we've seen in the past many years, where corporate reforms started from Japan, it's going to Korea, it's going to China, it's going to Singapore. You're seeing corporate reforms, a very interesting story in this part of the world, whereas in the US, buyback yields is going down. And if anything, supply and issuance is going up. So quite interesting dynamics there.
There's a linkage here as well with the topic around the Middle East and the energy price shock that we've seen, in that is that reinforcing the AI trade? We're seeing bottlenecks first showing up in semiconductors, but that's broadening out now to things like power equipment, energy storage, networking equipment. Is the two tied together, this energy supply shock and the AI trade?
I think from the fixed income side, it's definitely reinforcing. So, if you think about it from a macroeconomic point of view, right, you have a big capex cycle, which generally speaking means a demand side shock. That means if you look at, say, for example, Australia was not thought of as an AI beneficiary at all. But if you look at the 1Q GDP print, although the overall print was on the softer side, bulk of that growth was actually because of the data center build-up. And then we can see that on the net export side as well, where the net import has significantly increased because of the capital equipment needs to basically fund that and to make sure that the data centers have enough equipment. So that has been quite pervasive.
Terrence, very quickly, George alluded to the fact that there's a lot of capex as well that's helping to fuel this AI build out. We've seen that in the US and to an extent in Asia. How's the supply picture? Is it being easily absorbed by the market?
I think there are two kinds of issuers when you think about the AI built out in Asia. So first of all, we have seen hyperscalers trying to print bonds in local currencies in Asia. So we have seen one of them printing, say, for example, in Japanese yen. And we are certainly expecting that to expand in other local currency markets as well. So that so far has been pretty well received. And importantly, there are also local stories that are coming out. So recently, we have had one of the Japanese semiconductor companies being upgraded to a rising star. So they're now investment grade rated. Much of that, of course, is from the tailwind that we have seen from the memory and semiconductor cycle.
George, you touched upon AI demand. The sorts of signals you're looking at is US consumption. That's helping to underpin the reasons for this capex build out. We've seen a lot of adoption of AI in China, and yet there's still a little reticence, it feels like, from global investors to making big allocations towards China. How do you kind of think about the opportunity there in terms of maybe Chinese tech stocks or indeed the fixed income market?
When it comes to Chinese equities and Chinese tech, a lot of that is on the software side, and that has been somewhat under pressure, whether it's China or whether it's also in the US. The composition of the sector level does matter. And if anything, we've seen actually the Asia's market being a bit more resilient compared to the offshore market. And from our perspective, actually, that's also been part of our preference, the Asia's market. Why? Because just before the conflict in March, we had actually started to see signs of China coming out of its own concerns around inflation. We had seen CPI being on an upwards trajectory. We have also seen PPI. For a while, PPI had been in underwater. Now we have seen PPI starting to improve, industrial profitability starting to improve. So we had started seeing some signs of the domestic economy being a bit more resilient. Of course, the big missing piece is the property market and what that means when it comes to Chinese consumption. We have seen elements of potential sort of green shoots there, but we have seen that in the past. We don't know if that's going to be sort of lasting. But at a time when growth export in China might be coming a little bit under pressure, given what's been going on with the Middle East, we might end up seeing Chinese policymakers potentially sort of trying to boost a little bit more of the domestic consumption story. And guess what? The Asia's market, especially the mid-caps that we like, that part of the market is a lot more sensitive to policymakers trying to sort of to boost that part of the market. And when it comes to the fixed income market, most people wouldn't have realized that Chinese bond markets has been one of the best performing bond markets for the past 1, 2, 3, 4, 5 years, providing diversification and providing positive returns. Will that stay on from a long-term perspective? And this is where, starting yields are usually a very good indicator of expected returns. And, Chinese government bond yields were 5% a few years ago. Now, of course, they're sub 2%. So the expected returns perhaps is not as strong. But I still think that from a diversification perspective, they probably tick the box.
This seems like a good point to take a moment to hear from our Asian economist, Pei-Chin Liu, and her outlook for China.
China has shown resilience so far since the closure of the Straits of Hormuz, and that is due to a slew of policies being put in place. On one hand, China is running on large reserves, which acts as a buffer for now. On the other hand, the NDRC is putting a lid on the price pass-through to the consumer sector, and that is not yet shown on CPI prices. We do see PPI coming up to the positive territory as a result of oil price surge, but that has limited macro impact so far. We do not see significant change in the policy reactions for now, but that said, as the Straits of Hormuz close for longer, the risks is definitely tilted to the upside in terms of inflation outlook. The closure of the Straits of Hormuz has triggered rethinking about energy security and energy resilience across all countries. And that is a positive signal for China because China sits at the center of the green tech supply chain with its technology know-how and availability of minerals. In fact, that is one of the bright spots of China's growth insofar, and we do expect exports to continue to outperform and becoming the main driver of growth in the coming quarters. As the external sector and tech sector being outperforming, the domestic demand seems to be struggling to stabilize and has been coming up gradually on the episodic domestic stimulus being rolled out. We think that's going to continue to be the case going forward, given that the policy pivot has been squarely supporting the supply side. Property sector recovery will be critical to restore domestic household confidence and support consumption. So that is going to be a key pillar to support domestic demand. On the other hand, positive spillovers from export outperformance is hopefully going to provide another pillar for growth, given its support on wage and employment outlook. We think that domestic demand will continue to remain in a gradual recovery path in the coming quarters.
George, as Pei-Chen pointed out there, we've seen green tech exports from China growing significantly as governments around the world look to improve their energy security. So there's been a bit of question marks over the durability of that, but that would seem that this could be a continued driver of Chinese growth.
For me, I think this is a new export channel for China. I think previously that was all a domestic story. Again, now you're going to have all these other governments around the world, especially the ones that can fiscally do more. For instance, Germany. Germany has done a fiscal sort of bazooka, but if you look at its debt to GDP, it's still one of the lowest debt to GDPs around the world. So countries and governments that don't have that energy independence will, again, as I mentioned before, they will be looking to China. They will be looking to replicate what China has done. And who has the know-how? China has the know-how, China has the IP, and China can now benefit from this additional sort of export channel growth. And it's already happening when we speak to analysts and we're looking at these companies and we're looking at the cash flow that these companies are generating. They have been picking up quite meaningfully the past couple of months.
We've talked a lot about what's going well in parts of Asia, but there are other spots that are slightly more challenged. One of those is also a very large economy, and that's India. George, you've described India as being in a soul-searching phase.
India has for a very long time been the star performer, GDP growth, growing very, very fast, the equity market year after year performing very, very strongly. And as a result, India, being in that unique position, has managed to benefit from valuation levels that have been meaningfully higher than the rest of the market. Now, the past few years, China, would argue, has turned a corner. There was a lot of concerns in the past that China is uninvestable. Our view has always been that this is not the case. The reason why China has not been that interesting is because China has not been generating earnings. Don't generate earnings, you don't get sort of people's attention. That has slowly been changing, however, in China. As a result, India is not anymore occupying that, the only star sort of performing economy. The additional thing also when it comes to AI and what this means for India specifically, India for the past many years, one of its key exports has been services. people exporting sort of its know-how. Does this still have legs at a time when AI can perhaps perform a lot of these tasks and even sort of better, even cheaper, even faster? That's the big question mark that India itself has to think deeply about.
Of course, the government are obviously doing a lot to try and address some of these challenges, and policymakers more broadly. Terrence, the RBI kept interest rates on hold at their last meeting last month, but they've done a lot to try and support capital flows, protect the currency. Can you just describe some of those measures, their effectiveness? Is it enough? Is it going to support growth there?
They have a few measures that I'll categorize in two. The first one is to make sure that they have external capital flows. So for foreign currency non-residents, they have introduced a bank deposit scheme that is in concession. They're also encouraging SOEs and other entities that stay affiliated to borrow externally and channel the money back onshore. At the same time, they're making it much more attractive for global investors to invest in the domestic market. That's the second category. So they have, for all intents and purposes, removed one of the more steeper tax for investing in the Indian government bonds. At the same time, they have also provided swap concessions so that when you invest and you want to swap it back, you would be actually having much lower hedging costs than previously, which has been prohibitive.
Fantastic. This has been a fascinating conversation. We've gone across the region in terms of countries, sectors, asset classes. It's now time to bring it all together. I'm going to ask you two more questions. I'd like each of you to give me your best opportunity that you see at the moment for investing in Asia and the one risk that worries you the most.
I can kick off, and I'd say, we talked about Japan coming out of decades of deflation and disinflation, and something really big is happening. Japan mid-caps because, again, the domestic economy is strong, and if anything, the government, Takaichi government, is doing more fiscal stimulus. Who benefits from that? Of course, the domestic economy benefits from that, running sort of hotter in some ways. And wage growth, again, is resulting in better domestic growth, which in turn is translating into better domestic revenue generation, better earnings. We also talked about corporate reforms. The corporate reforms have been very evident in the large caps in Japan. We're now starting to see those also having an impact in the mid cap. So there's more of a catch up to do for the mid caps. And the last bit is also a lot of folks are worried about the yen. Is the yen going to weaken further or not? Could it strengthen? If you're invested in the large caps, you have to worry about that, and you have to have a view on that. If you're invested in the mid caps, you don't have to worry about that, because the currency is not going to really affect much what happens with that domestic revenue generation. So you've got decent valuations, improving fundamentals. You don't worry about the yen, more fiscal spending, wage growth sort of growing. What's not to like? And so that's kind of what the positive. Of course, the negative here is Strait of Hormuz has to open, because things have also been relatively resilient in some ways, because you look at the US has been exporting. It's running down its reserves, its SPR reserves. They've been drawn down. At the same time, China has reduced its imports. Both of these dynamics will face pressure at some point. So, time is not your friend when it comes to Strait of Hormuz having to open at some point.
Terrence, for you, the opportunity and risk.
Since we have talked about already the RMB bond market, so I'll cast that aside and I'll perhaps go a less treaded path, which is Hong Kong dollar bond. Basically, it is the best performing market when it comes to absolute return and risk-adjusted return in the past 5 years. So because of the previous rate cycle on a more synchronized manner, so if you, let's say, for example, in 2021, bought some kind of bond market that has international recognition and rating, so US bond, Euro bond, whatever that is, Hong Kong bond would have beaten them by a fair margin, actually, in absolute return and also volatility adjusted return. Why is that? First of all, it has the highest average rating of the international rated global market. So on average, it's pretty much at high single A or low double A in rating, and 80% of the underlying constituents are actually A rated or above. So in a situation where you see many rating pressures for the likes of US and some of the Eurozone countries, of course, that has been very much clamored about by the broader market. And second of all, there are structural buyers. So what we have seen, of course, is banks and insurance companies, they have increasingly bigger books and they've been deploying that marginal dollar into it. Either because from a loan to deposit ratio point of view for banks, it has been coming down and therefore they need high quality investments, and that means Hong Kong dollar bonds will be the primarily drivers for domestic banks, and they're also increasing insurance policy. So we don't expect that to move anytime soon. And importantly, it has exhibited a very strong buy on dip behavior. So the biggest part of outperformance in terms of total return and volatility adjusted return and when rates sell off. So because many of the local buyers, they have a lot of money and they tend to come in when the market is a bit more concession for them when rates are actually higher and yields are actually higher. So if you want something that's much more downside protected, but still give you meaningful total return potential and importantly outperformance versus the core markets, look at Hong Kong dollar bonds.
And your risk?
The risk, I think it's important when we think about what happens after the Strait of Hormuz. And in the second half of the year, we have expected that food inflation, and in particular El Nino, will be one of the things that the market will have increased attention about. So first of all, as it stands, Asia already has to import quite a lot of fertilizers from the Strait of Hormuz. So the Middle East theme is very much in play there. But even without that, we are expecting El Nino to be quite strong for the rest of this year, which generally means the crop output will be lower, and therefore that would increase another level of inflationary impulse for much of Asia and emerging market as well.
That's all we have time for. Thank you so much, Terrence and George. It's been a fascinating conversation. It started obviously with a story around higher oil and gas prices, and I think it's become a much broader discussion around resilience, investment, and of course divergence across the region. I think what this episode has really kind of highlighted to me is the fact that Asia is really being reshaped, if you like, by two really dominant themes, and that's energy security and AI investment. And that's creating a much more differentiated investment landscape than in the past, and perhaps that more so than many investors really appreciate, and throwing up a mix of opportunities and risks. Okay, that brings us to the end of today's episode. Thank you, George and Terrence, for joining me. You can find more on all of the topics we've discussed today on your local Fidelity website or on fidelityinternational.com. If you've enjoyed this episode, then please like, share and subscribe. The producers today were Rory Fong, Patrick Graham and Judy Chen, with production assistance from Tommy Sue and Keith Chuen. The managing editor was Seb Morton-Clark. We'll see you next time, but for now, from all of us here at Fidelity, goodbye.